Is January 16th, and we are headed into the first options expiration of January 24. Excuse me, 2024, and it is a big one. So how you doing, man? You ready for it?
Yeah, it came quick though, didn't it? It's like literally the year, it just came so fast.
Yeah, the time is flying, absolutely. And we have a lot of interesting things to talk about today, actually, with these big options expiration positions. We have a very resilient S&P 500. I'm curious to pick your brain a little bit on some of the little macro things in terms of rate expectations. But I wanted to start with some really interesting analogies that I've been watching from December of 2021. So indulge me while I pull everyone through this. Alejandro, good to see you, and Bob Tag, good afternoon to you as well. So let's flip forward first through this analogy. We'll start with this, and then maybe we could talk about some of the single stock stuff. Where did I go with my little analogy here? I have it somewhere. Here it is. All right. So if you remember in 2021, there was a massive stock market rally. Let me make sure I actually share what I'm talking about. Bam, there we go. All right. I need to hire a producer or some. Never mind. All right. 2021, there was a massive stock market rally, kind of like there was in 2023, right? And that led us to this point here of the 4,700-ish area, and that's right around when actually people started to come around to the idea, hey, we're going to have to start raising rates next year. The market digested those early tremors, and it closed at or it set a record high on January 3rd of 2022 at 48.03. We then saw the market drop kind of in two little stages here, down about 8%, that's the S&P, into January 22 OPEX, with the low of January being made on the day after options expiration. That was also the intraday high of the VIX of 38. And that intraday VIX high came despite the fact that we had the Russian invasion of Ukraine and much lower markets and higher rates and yada, yada, yada. And so the reason I think this is so fascinating, and I'd like to get your opinion, obviously, on all this momentarily when I finish rounding this idea out. So you can see that kind of 8-ish% drop overall. You can see FOMC obviously stacks next week. We also had, this was super interesting. Last week, we had a CPI, which came in a little bit hot. The market initially sold off because of that, recovered very quickly. So it was kind of a blip. Back in January 14th of 22, one of the triggers for a pretty big drawdown or kick started to move down was a hot CPI that came in. Now, obviously, we have rates arguably, well, they clearly were going to go up in January of 2022. Now people are positioning such that they think rates are going to go down. They're pricing in a bunch of cuts. So that's a different macro theme, obviously. The other thing that I thought was just kind of an interesting thing to add in was the Russian invasion started the first kind of 2 weeks of February, was when that really picked up. And it seems like the geopolitical tensions here may be percolating a little bit. I'm not going to get into my analysis of that because I don't have one to offer. I just say that it seems like, missiles are really starting to fly there a little more fervor. And then, the last thing around this out is you can see we've been unable to break that 4,800 level the last couple of days, even though we've tried, weeks. 4,700 was something a little bit of initial support level. And the last thing I'll say, Imran, before I pass the baton to you is during this OPEX week, we put this in our founders note this morning. During this OPEX week in 2022, we lost 5.6% in the S&P. This is a shorter week. It's only 4 days, but I think it's these January options positions we'll talk about momentarily that's driving this. How do you generally feel about analogies? How do you feel about this analogy? You can give the whole thing a thumbs down. We can just move on on it.
I think seasonality, I do think, has some value in observing. So there is some cyclicality in markets. There's people who do tons of analysis on seasonals, and some of the work that they do I find actually quite useful. And there's some years where seasonals work amazingly, some years where they don't work necessarily as well. Last year happened to be a really good year for those who looked at cycles and seasonals. Whether this year is or not, who knows? Obviously, we've got an election year. We've had a big rally already. Valuations have had a bit of a run up. Anything can happen, right? I think something Jem Carson talks about a lot is that December and January OPEX tend to be the most supportive ones of the year. And so he actually puts a lot of the Santa rally seasonality down to the fact that a lot of the choice maturities of hedges and stuff that you've had on your books for years, if you're a market maker, happen to roll off in December and January. And as those things are rolling off, the charm flows tend to be at the margin supportive. And once all those options positions are cleared out, you then tend to get periods of weakness. So you look back at past years, you get periods of weakness in February, March quite regularly, right? So it might be that we're setting up for something similar like that, for sure. But ultimately, I think any dip that comes will get bought in an election year. The point you mentioned about rates is interesting because we got a hotter CPI print, but then we got a PPI that was weaker, and the rates market said, we are still cutting. In fact, we're going to price in more cuts than we did before CPI. So on the week, you had more cuts priced in the front than actually you had before this hot CPI print. So it tells you that the slightly hot CPI print isn't really what the market's focused on. I think there's a lot of chatter now about QT ending sometime around March because this reverse repo facility is going to run out of cash by then or something. I don't claim to know all the details and understand the plumbing stuff, but the plumbing stuff that people talk about is basically suggesting that the Fed pivoted because they see this coming and they're going to have to stop QT because that's the only way you're going to be able to fund the deficit, basically. So in an election year, you're going to have to fund the deficit. So I think it's more being driven. I think the rate stuff is being less driven by the inflation headlines and being more driven by these fears that the system is in need of a slowdown of QT, if not completely stopping QT. And that's why the rates market is priced where it is, I think.
I think that's those are great points. And what I think is interesting about it is that if we look at, this range, we've really been stuck in this range for the last, month, basically. Right. And so what's interesting to me is, this is sort of the CPI print here. And we just kind of rallied back from that, is that if we are pricing in all these cuts, the market has really stalled out at this level. If you look at Mag 7s and the like we really pushed up against 4,800, just under all-time highs, like in the NASDAQ and stuff, but we don't yet see, bid to calls. It's sort of like, I think people are really sitting on their hands right now, waiting maybe for confirmation on the FOMC to unlock that further upside. And if we look at the 4,800 strike, it's a really massive level, 4,800, as well as 480 in the spiders, which is about 4,815. So there's that upside zone. About 30% of this gamma expires on Friday. I think that's really been keeping, something of a lid on things. And so if you do want to talk the bullish side of things, because I have a lot of other things which I think are maybe bearish, you want to talk the bullish side of things, it seems like the market, by and large, in general, is kind of pushing up its ceiling and then really wants to maybe hear from the horse's mouth that, it's all clear. Or, hey, earnings have just showed us that, PEs are really reasonable. So let's all start to bid this thing up and officially break that new high, right? And move along.
I wonder where the market would be if there weren't 6 or 7 cuts priced into the rates curve, right?
Yeah.
If the rates curve was in line with the dots from the Fed, which is like 3 cuts, right? Then would the market be at 4,600? Probably. So I think
you would think so.
Yeah. So I think the reason we're here. So I know you're saying the market's stalled up here, but I would say we probably would be a bit lower than here if there weren't so many cuts priced in, right? So
that's a totally fair argument. I guess I just think that with if you're going to suddenly, if we're at all-time highs before we started pricing even more and more and more cuts, we got confirmation from some of the Feds, and you could say, hey, the CPI, or PPI combo has cleared the way for, even more, cuts, and we're getting kind of out of my depth here, talking about rate cuts and things like that. That didn't necessarily give the all clear trigger. So to your point, maybe that's why we are remaining at all-time highs, but I don't yet see traders positioning for saying, okay, we're ready to go to 5,000 now in the S&P and kind of take that next baton. So the first thing that we got to deal with, and I want to transition quickly here to options expiration. For this expiration, the other part of this analogy that we had talked about here is that, this January options expiration, which was, I believe, the largest single stock expiration ever up until this January options expiration. So what you see here in purple is the amount of single stock calls that are set to expire, the delta notional value of those positions with puts in teal. And so we have, billions and billions and billions of dollars worth of calls, single stock calls set to expire. And these are leaps, meaning that they were bought, a year plus ago by, always poke light at or make fun of Nancy Pelosi, right? Because she's the famous one to do this. But people bought these calls a year ago. The markets rallied 50%. Single stocks have rallied, 1, 2, 3 times. And that's driven these call values to be very large. And the theory here is that if you know that people bought these calls and there's, dealers and market makers, liquidity providers are short, there has to be a big single stock call hedge on. I don't think you can hedge Tesla, just by buying Qs and netting that part of your book out necessarily. So it's like one rough example. I believe the unwind of these hedge positions was a major driver, excuse me, of that 5% in drawdown in January of 2022. And that's why, I also make sure to flag this idea that the low was made the Monday after options expiration, right? So, that links those two times together. When you look at, something like this or positions like this, how do you break down the potential impact, or what are you thinking about in terms of, this size expiring? Is it a lurking risk, that you see, or is it something that maybe is a little overblown?
Personally, I don't put too much weight on it, to be honest, because I don't know that number itself tells us that much about how much is going to be unwound and how much isn't, right? Because we don't know, for that position has obviously got a stop position against it. And like you said, when it expires, you either deliver the stock to whoever owns the call if they want it, or they close it out, right? Or but we don't know when that's going to happen, right? We don't know whether people are going to just take delivery of stock and then slowly let go of those stock positions over time, or if it's on OPEX that they're going to sell those stock. Personally, I don't see a good reason why the majority of that stuff gets sold on delivery, right? I mean, you essentially, if you have an in the money call, leap call that is well in the money, that has been behaving like a stock position for months and months and months now, since it went deeply in the money. So if you didn't want it anymore, you would have already hedged it or you would have already sold it out, right? But you see what I mean? So I don't think for these deep in the money options, I don't think there's a decision necessarily that needs to be made on expiry. If they were cash settled like index options, it's a bit different. But because they're physically settled, I don't think the expiry date is as important as it is in cash settled index.
So that's interesting. So I would actually think it's the other way, that because they're not cash settled, they're more impactful. What makes you say that?
Because the cash settled by definition is a delta that disappears, right? So someone has to actually then transact that delta because it's gone, right? Whereas in a single stock, there's no change in delta because the stock, the option that you're, say I'm a market maker, right? And I'm short a call option that's gone deep, deep, deep in the money, okay? Then I'm long stock against that, right? But when the option expires, that delta doesn't disappear and I then have to dump the stock. All that happens is I deliver the stock to the person who exercises the call option because it's physical delivery. Physical delivery means that the delta doesn't disappear. Cash settlement means that the delta disappears. So there actually needs, if people want to not have their delta suddenly change, they have to then transact basically on expiry, right? But when it's physical settlement, your delta actually doesn't change because all that happens is the mechanism of physical delivery, physical expiry or settlement, whatever you want to call it, just transfers you from having the delta on the option to having the delta of the stock, basically.
Yes, that's a valid point. It makes a lot of sense. I think that so from your perspective, then the question is, does Nancy Pelosi, and I don't know if she owns Nvidia, but just as a joke of a thing to talk about, does she want to take the assignment of whatever 100,000 shares of Nvidia? Like, yes, she has the calls already on her book, so in theory she already owns those calls. But then she's got to take, she's going to own all those calls still, or does she sell out of her Nvidia position and roll it to, January 600 strike calls for next year, right? And then so in there would be the deltas that have to get sold off. Where I've felt in the single stock side, you have the cash exposures, which are maybe easier to estimate and easier to hedge out because you have the 0 DTE positions now that maybe give you a little bit more dexterity in how you may hedge. But to your point on the delivery, I suppose if you just say, hey, look, I'm short calls, but I'm also long the stock, and so they're going to get assigned, and then I don't have anything to worry about. If you do assume that Nancy's just going to take her shares and hold them for the remainder of her days, then in theory you are. Now, if we start to sell off now and earlier, like let's say this week we just started to slide lower, then maybe that would force people to take action. That's our argument I've been making, that okay, those deltas are going to start to get adjusted now because you have to make those adjustments now. In other words, if Meta starts to sell off, it has a big expiration on Friday. If this starts to sell off today, you have to make adjustments to your hedges today because obviously expiration is not for a couple more days.
Yeah, and that's that's like if they're not deep in the money, but if your options are more short dated and they're quite high delta, but they've got a load of gamma on them, then yeah, you're going to make decisions in real time in the expiry week because there's optionality. I think the point I'm trying to make is with the deep in the money stuff, there's no real optionality left on a lot of these options, right?
Particularly if the market goes up, right?
Yeah, optionality comes from basically uncertainty of exercise, right? If there's no uncertainty of exercise, there's no optionality, which means an option is the same as a stock position. If it's an in the money call, it's the same as being long a stock. If it's an in the money put, it's the same as being short a stock, right? The optionality comes when you are near strike. Either you don't have to be near strike if you've got a long maturity, but if you're very close to expiry, you need to be near strike because then there's a ton of optionality, right? You could suddenly be in the money or you could be out the money if the market moves a few percent, right? And that is the stuff that in real time people will rebalance and people will trade and will have a lot of time decay on it as well and have a lot of charm that will be changing. The delta will be decaying through the few days into expiry. And those are the impacts, I think, that will be seen in markets. If markets are moving a lot on expiry week, I put it more down to that than I put it down to deep in the money deltas because I think the people who trade that stuff professionally at least will know that is like having a stock position. So if it's like having a stock position, whether it's expiring or not, it's like having a stock position, right? It's just either on my book, it's actually an in the money call or it is a stock position. I don't really care. My exposure is still the same. So if I wanted to do something with that exposure and reduce it or whatever, I don't have to wait till day of expiry to make that decision. I'll make that decision when I decide I don't want to own the exposure anymore. And that will be dependent on other things that we as option traders don't necessarily know what they are.
Yeah, and I see what you're saying. I agree with it. I think I've been marking just as a rough risk level 4,700 as this area where and you said it more succinctly, but 4,700 is a level where that optionality would kick in to me because that starts to move some of these stocks arguably lower enough. Like if Meta slides 5%, then the way that you need to hedge that in these options expiration positions is different from if the market just kind of stays here in this very kind of neutral zone of near all-time highs. So some excellent insights there. Thanks for those, Imran.
No worries.
And I think what the takeaway I have is like, look, if we start to have this outsized move lower, I believe firmly that there's a lot of reasons to think that would be both this options position and then some of these volatility slides I want to talk about, can be triggers for options induced downside or options, uptick in volatility in a way that, I generally don't see in options positions. And so if you kind of understand that going into this week that, hey, if we do really kind of move more than we would expect, or the potential's there to move more than we would expect, then I can, as a trader, handle that in a different way than if, I was thinking that, hey, it's some news item that really has punched the market lower, is that, it's kind of inducing all this volatility. So, it remains to be seen. I will say this about markets. They don't care about going down right now. S&P 4768 is only down 20 bips on the day. We were down 60 in futures this morning, but micro dips are now getting bought. So I want to scroll through some of these questions here. Thank you, everyone, very much for
We've got VIX expiry, right? We've got VIX expiry on Wednesday, and we do often see the market being a little bit supported into VIX expiry because you get pressure on the front month VIX future. And that basically converts into a bit of a delta purchase on S&P. So it might be that the S&P is not selling off because rates are moving, right? Rates are moving higher. I mean, you've got TLT down 2% today and S&P is doing nothing. I think that might be because of the VIX expiry kind of holding the market artificially up.
That's an extremely valuable insight, and that we've definitely seen several times, and we've chronicled them, on Twitter and the like, where just to what you said, Imran, that that VIX expiration, has held up the market, or we see sort of a binary kind of like switch flipped right after options expiration, which is at Wednesday morning, right? So, which is now tomorrow morning. So, I actually did not pick up on that insight and mentioned in our note this morning. So, thank you very much for bringing that up. Because to your point, and to several of the chats here, like Jay says, Waller turned the tape bearish, and the 10-year jumped to 4.07. Paul Trader McGraw, good to see you. He says structured product overwrites at 4,900 and 4,950. So that's that overriding, along with the JP Morgan collar roll in the JEPI fund. There's a lot of call overriding in the S&P, which, forget those OPEX effects of those. That's structured selling. May really be a dampening effect of volatility to the upside.
Did you see that big VIX trade that went up on Friday?
Yeah, so let's talk about that. Paul's also mentioning here that VIX 15 trade last night. There's people saying that's why the VIX VVIX kind of popped a little bit. I'll just bring that up. I know you made a couple tweets about that. I thought they're great. So why don't you tell us what you think about that? I can bring up the details of the trade, so we can have those labeled.
Since the start of January, I've been looking at the VVIX kind of trading down and down and down, and it was a bit surprising because you hadn't seen as much call option buying on the VIX as we were used to seeing. It's quite systematic generally. When vols are this low, people realize that owning VIX calls is probably a better way to hedge themselves than owning S&P puts, because the VIX is kind of floored at around 12. So it makes sense, got more asymmetry. But they weren't buying a ton of February and March calls. And actually, we saw some buying of May calls a couple of weeks ago. And then it was on Friday just gone. We had this massive clip of February 17 calls go up in like $16.5 million premium, which is 250,000 lots, which is $25 million of Vega notional, which is massive. One clip, right? That's the kind of stuff that they would generally accumulate over the course of a month. But that's one clip. So that spooked, that basically made the VVIX pop by about 20 points in the last 2 days. And that's kind of got all the VIX dealers suddenly short again and scrambling to cover. And so you've seen a little bit of a bid. VIX futures actually haven't gone as bid as you might have thought on that, but VVIX has gone mental. And some of the downside puts in S&P, the deep out of the money stuff is starting to catch a bid, because that's the only way of getting any convexity back, basically, right? So it's the way people who can't buy convexity on VIX because it's gone too expensive in a heartbeat, will then look to deep out of the money puts on S&P to give them something explosive in case the VIX goes, right?
Yeah, and to your point, maybe the VIX expiration here is dampening things. And just, I want to pause real quick, because what the VVIX is measuring is essentially VIX skew, right? So when out of the money VIX calls get bid up relative to the at the money, that's when the VVIX pops. And so I guess what the theory here is, the idea is that this demand, there's a really nice chart on your Twitter feed there, options_insight. This VIX call buying at the 17 strike is lifting up those VIX calls, the value of those VIX calls, which is in turn shifting up the VVIX. The VVIX, I think there's been a lot of back studies on it, and I think it's super interesting when it pops like this. It's not always a signal of impending market risk, but the fact is that anytime you have a big VIX call buyer like this, it's pretty interesting and catches eyes, because vol in general has been, really pretty low, right? And I have a bunch of slides we can talk about that. Also, William Klein says inflation adjusted 50 cent is back, which is pretty funny. For those of you who didn't know, 50 cent was his trader used to always buy 50 cent VIX calls that cost 50 cents, and he would do it. Was it month after month? I can't remember what it was. He did it religiously, and then eventually, finally, the market, VIX ripped, and the trader made a ton of money. And it's a special type of person that can take that pain for that long, and then eventually it pays off, right? But
yeah, I mean, it was that Ruffer fund that was doing it, right?
Right. It was a European fund, I remember.
Yeah.
So let's let's shift a little bit here. It's not a full pivot, but I wanted to get your opinion on some of these things. So, we recently launched an implied volatility dashboard, and we're going to have a little bit more of a full launch, later this week, and then in the coming weeks. But what I wanted to talk about was the term structure here and get your opinion of it. This is the current term structure of the S&P 500, obviously. And so this cone here is the high and low of the it's the 90th and 10th percentile. And so you can see that, we're kind of in the average, in the middle of this zone over the last 60 days. But this 60 days has been a pretty, a period of rather low volatility. And even the sell-off, it's not even a sell-off. It's like we're down only 30 bips. Lifted vols a little bit here. But there's this saying, and I'm interested to get your thoughts on this. There's a saying, obviously, in markets that, cheap volatility or low volatility is not cheap volatility, right? Mm-hmm. And how do you know, or how do you start to evaluate where it's actually, hey, this is actually cheap and something I should get long because it is cheap as opposed to just low? What are some of the metrics that you would look at to sort of start to draw some of those conclusions that, hey, look, if I'm buying 10% of money, S&P puts at like an 11 vol, I just got to buy them, right?
Yeah, I've got my own vol dashboards, right, that we do over at Options Insight, and mm-hmm. I kind of look at statistically where is implied vol in its range.
Yep.
To give me an idea whether implied vol itself is cheap or expensive. But then I have to also look at the carry side of things, like is it realizing? How is realized relative to implied? And is there a reason why it's trading at the lows of its range because it just can't realize? So you've got to compare the two, and that kind of is the input. Those two are the biggest inputs really into that decision of whether you want to buy vol or not. Now, I would say, we've been seeing systematic gamma selling, and it's just been happening every week, every day to some level, and it keeps stuffing the street in local gamma, and it makes it hard for the market to move. So the bar to want to be long gamma has got to be pretty high, right? There's got to be a pretty good reason for you to want to be long gamma, because the whole street seems to be long it all the bloody time, and the market mean reverts intraday, even if you get a move, and it's very hard to make any money out of that. But implied vol, if you start to watch what that's doing, is it seems to have found a bit of a flaw, right? So whilst really short-dated options bleed and they don't make you any money, owning things like VIX futures, owning sort of more longer-dated part of the curve isn't killing you, basically, right? So I think owning calendars, owning implied vol and being short gamma is probably the right setup. And the good thing about doing that is the gamma that you sell, you can do it via iron condors, or you can, even if you do it outright, it's very local. Because if you do it around here or the 4,800 strike, 100 points lower, there's no gamma on that. It's disappeared. And then all the Vega that you've got, either via your long VIX positions or your longer dated optionality, that all kicks in and could potentially make you money. So that I wouldn't make an outright call right now on buying vol. I would be earning theta via very short dated stuff, which is contained, like iron condors or whatever, which is what I've got on actually for this Friday. And then I would be buying implied vol exposure in things like VIX, maybe VIX call spreads, things like that will not decay badly, but will give you some explosivity to a move if it comes.
Those are great insights. I know Chase here just asked about fixed strike vol and what that looks like. And so, if you look at, this is 1 month S&P skew, for example, here, this is from Friday's close, right? So, today's move is shifted up, kind of like a parallel shift of about, 1 point. So even though we're only down about 20, 30 bips in the S&P, but like you mentioned before, rates are moving a little bit, and there does seem to be a little bit of a perkiness to vols. Yeah, and Chase says, TLDR, we're dumping this garbage starting tomorrow or not. I mean, look, I'm surprised by the resiliency of the markets. Like, we continue to get these, these micro dips bought. We can look at this from a fixed strike basis. This is one of the new tools we also bought here. We've actually never shown this publicly, so this is the kind of the first shot. SpotGamma subscribers have been able to play with this, but this is fixed strike vol as it stands right now. And what we're seeing is, for the first time ever today, the darker shades of green suggest that implied volatility is up a little bit on the day. And so, there are these shades of green, whereas this has been shades of red indicating volatility selling for really the last, even in the face of when we were testing 4,700, we were still getting these shades of red in this matrix rather than green, which tells us that volatility now on a fixed strike basis is finding a mild bid, I would say, right? So it's funny because it does seem like maybe volatility traders, and Paul here says, hey, the VIX 17 call buyers up 30% on the day, or since he bought them, good for him. But it does seem like maybe there's a little shift in vols that seems to be a little bit unusual given what I believe I've seen over the last, call it 1 to 2 weeks.
Yeah, this is in the last 2 days, but I'm putting it down to that VIX flow, because you got to you got to know how the VIX market makers hedge themselves, right?
Mm-hmm.
Your first port of call is VIX futures or options, but that finds a way, like, if someone's getting carted out of a load of VIX futures or options, they've got to get the Vega somehow, right? And it's all derived off the S&P vol surface, so it is going to translate to a bit of a bid in particularly in the teeny stuff, like the low delta stuff on the downside on the S&P. So I think that's the driver of this fixed strike bid that we're seeing. That's not to say that it's not going to continue. It could do, but I think that is the driver, because that is the big incremental flow that's come into buy vol.
Yeah, and I would also say, just to add to that, is that the reaction to any type of even mild vol bid has just been, it seems like, to come in and smack it. So,
yeah.
This is another reason why we've been really leaning on this 4,700 levels, because like there's a point at which the apple cart tips over, like, and then finally, okay, like vol is really going to break it. This time is real, and I think you have to give benefit of the doubt to it being a real move in vol until like we really break 4,700, which I think finally we get a vol jumping enough that it's not so easy to kind of like stuff back in the box. And so that's what we're on the look for now. But S&P, as we've talked a bunch of times, has been just very stable today, despite some of these other factors, and maybe that is relating to VIX expiration a little bit tomorrow. I would also say that historically, when you and I do these monthly options expiration calls, something moves generally pretty negatively. So
yeah,
I don't know. We'll
or straight off, like the day or two after it goes down, basically, right? So.
Yeah. So there's a lot of movements in and around here. All right. So, the volatility perspective, we said that, the pump appears to be getting primed, as we mentioned in our morning note, but, we've had these false starts before, and, this price action, the S&P, just is very, very stable at the moment. And so, it's hard to want to bet against that at this time. I have a couple of slides I want to talk about the zero DTE stuff, which I know when I say zero DTE, a lot of people immediately kind of like their eyes roll back in their head. But the reason that zero DTE is so interesting to me is that we're setting new records in terms of the size of zero DTE that's getting traded. I also have this anecdotal thing that I think is interesting, in that I've listened to a couple of interviews recently about zero DTE from kind of industry professionals, not so much traders, but industry types, and they actually start to like giggle and laugh about zero DTEs and what they think the impact is, and that's getting overblown, and they're kind of like having a laugh about it. And what I think is interesting about it is oftentimes that feels to me like an anecdotal signal that, okay, now it can break something because they're making fun of it. But anyway, this is data from the OCC. Now, the OCC is the Options Clearing Corp. They actually tell us each week how much contracts for the previous week were bought or sold, and they tell us equities, index, ETFs. They don't break it down any more than that. But S&P is the biggest of the index flow, so we can assume that this is the bulk of what's happening on this bottom chart. And as you can see here, we set a record, like blowout record, for the most index call options bought to open. So those are call buyers on a contract basis. It's a record. I suppose some VIX calls would factor in there, that long, but the bulk is just going to be S&P. On the top is measured in premium perspective. So obviously zero DT is going to cost the least amount of money to buy. And as you can see, there's no breakout in premiums bought. So my conclusion from this is that this is zero DTE contracts or very short dated S&P calls getting bought. That's what this is showing. It's a record. And yes, the puts were up a little bit, but nowhere near as much as these calls, right? So I'm flagging this as record zero DTE calls bought to open over the past week. Feel free to interject at any moment if you see something of interest there. I'll move on to the second slide here, which is actually a percentage of volume chart. So S&P 0DT volume. The record on 12/22 is 56%. This past week on Thursday, we did 55%. Friday, we did 53.5%. Only one day this past week was below 50%. That was at 49.7. So if we just rounded it slightly, we'd be at 50%. So, there's this, it feels like something has changed a little bit. And I've seen this in the flows, anecdotally, where it looks like dips get bought with 0DT and force. This chart supports that. This supports that, there's this elevated flow taking place.
So these calls are getting bought. Are people buying them and then selling them by the end of the day?
It doesn't show up in the sells. It's a great question. I didn't post a sales chart because I checked them, and we don't have a record in sold to open nor sold to close.
Okay.
So they appear to be being held. The last thing I would say is that this is our hero chart from Monday. Hero measures the delta value essentially of all the options being traded. So in the S&P, the purple line is all expiration flow. So any expiration, that 12 billion number is an official record, largest number we've ever seen, largest, most positive number we've ever seen. This is the day the S&P rallied 1.26%, I think, on Monday from that 4,700 low. 72% of that was 0 DTE flow. And so, look, the counter argument to the 0 DTE flow is that, they giggle and they say, look, there's as many calls being bought as puts, which is a ridiculous way to say that that's why flow balances out, right? Because you can't just say the number of contracts that traded is equal to the number of calls and puts, and that means exposure is hedged out. But the second argument is that, look, 85% of this flow is institutional. And so, 0 DTEs are hedged out with other 0 DTEs. And I can think of a variety of different ways that would break down, meaning that if I'm a liquidity provider, I'm the one trading all 0 DTEs, that at some point I can't just totally lock out my exposure with other 0 DTEs, particularly when we only have, I think it's 6 or 7 large market makers, right? So I said a lot here, Imran. What is your current view of these 0 DTEs? And can you outline a way, and feel free to go against what I just said, can you outline ways of which these 0 DTEs can't just be hedged out with other 0 DT contracts, and so it's all done and dusted in terms of the exposures?
I think 0 DTEs are useful as like a delta trading tool intraday. I think people are using it for that. But then they're also using it to systematically sell and earn premium, right? And do it every single day in small size and just nick a bit of theta. So to me, it does seem like the market is relatively balanced, but still at the margin, I think it's a vol suppressing thing. So vol trades cheap because at the margin, there's quite a lot of selling of this stuff going on. But I do think, and some of it's coming through, ETFs, systematic ETFs and things like that. But I do think things can turn on a sixpence, right? I think it's like if you get a reason for the market to go down, and you get like a handful of big clients who come and lift like clips of like 20 to 50,000 0 DTE puts in short order, then this turns into a shit show, right? Because all of a sudden the market makers assume they're going to be able to get their gamma back because they've been able to get their gamma back for the last God knows how many months. But they underestimate that the liquidity can just evaporate. Because this is the type of stuff that happened to me back when I was trading in the banks in 2010. So you when you're in a quiet market where nothing's really going on, things are very liquid and you can trade massive size, much bigger size than you even thought you could. And it's all fine and nothing ever moves. Vol hardly ever moves. You're encouraged to trade bigger and bigger and bigger size. All of a sudden, when the game changes, and it's hard to know what the catalyst for that is, but when the game changes and suddenly people realize that they don't want to be short risk, that liquidity that you're relying on, that you just provided to your clients, is nowhere to be seen, right? And when that happens, that's when 0 DTE gamma goes from 10 vol to 50 vol in a day, right? So I think that is the risk. The risk is people get too comfortable that they're going to be able to provide this liquidity in monster size to whoever wants it, and they'll be able to cover it. And there will be one day where they can't cover it, and a few guys will go the same way, and the market will cascade through a load of this gamma, and that gamma will be in the billions, and it will drive markets down 5%, 10%, whatever it is, right? So that's the risk for me.
Yeah, it's that imbalance that tips, and in a way, what you sort of just described was Volmageddon, right? Because everyone was selling vol, and then as soon as you got, realize was at 3, and so when realize went to 6, everyone's like, ooh, like expensive volatility, I could sell, and then they, and then everyone just kind of run over, and it's the same idea, I think, here, where I guess that's also some of the reflexivity there, and Neil mentions HFT Delta 1. JP Morgan said that they were going to start using this more. So, there's a variety of different players, which is one of the arguments that you say, hey, look, this actually adds to, it's that diversity, strength and diversity kind of argument. And to your point, it doesn't matter until suddenly it matters. And then it matters a lot. And then I think when you get those times that matters, when you can't just hedge out that 5% move by buying other 0 DTEs rapidly because everyone else is doing the same thing, and there's such a one-way bid for that liquidity, right?
But the good thing about it, though, is whilst it definitely has the power to create a bit of a crash on any given day, because it just, the amount of gamma someone sells is too big, and then the market just moves through, and they're forced to trade delta against that short gamma. The good thing is that it is cleaned out by the end of the day. So it's not something that's going to persist, right? Because if someone blows themselves up on a big 0 DTE trade, then the next day all the market makers are going to be more cautious, right? It's like what happened with GameStop. GameStop did stupid stuff, and then they stopped selling single stock vol at those levels, and they realized that they need to charge more, right, for those meme names. So It's a similar sort of thing. I think, well, if one day we get a move that gets exaggerated by 0 DTEs, then the market makers will have to apply a bit more risk premium to 0 DTEs, most likely.
Yes.
But if the systematic sellers keep coming, then that risk premium will get crunched back down again, right? But like I say, it'll get naturally cleansed every day because it is only one-day options.
Right. So it's almost a vol thing in a way. Then you kind of get you kind of maybe have more jump risk, and then I think these sellers will come out. But the other, so the scenario that scares me in that instance is like, if you remember when Knight Capital went down, I think it was 2014, and that, they had all these trades going kind of haywire, and they blew themselves up. And I think that a lot of their trades were busted because, there was a big bank on the other side. And it's also kind of like the nickel trades, right? Like all those trades got busted as well, where the risk is we have, 5 or 6 very large market makers here. And if one of them goes down, is that what is the echo of impact from this, as opposed to your point, the exposure is cleaned out at the end of the day. Okay, maybe someone just took a loss, but the next day the exposure is gone. If you did have an entity on the wrong side, and so far, liquidity is, it's amazing how well the system operates. And, in general, you wouldn't expect any sort of risk. But if you're going to outline why risk would extend, it would be if you start to have someone a la Knight trading kind of off sides, and then does that have kind of, again, an echo of problems. But, that's the extreme tail risk that I would see in the way that it would, 0 DD could have a larger kind of impact from things. Yeah, I don't know. Tim asked something about the margin call you're speaking of. Likely what happened is repo and BTFP are empty. I'm not sure that that Fed liquidity would play into a situation like that. I suppose maybe it's a trigger for why the market starts to slide. It could, but there also was, and Bill brings this point. Yeah, I'm sorry. Go ahead, Imran.
I'm not even talking about a large margin call. I'm talking about that a handful of clients decide,
like a single entity,
or even one, lifts like a ridiculous amount of 0 DTE options that has a lot of gamma on it, that is just too big to hedge without having market impact.
Right.
And it has a ton of market impact as those deltas get hedged as the market moves through that strike. Right. That's what I'm talking about. I'm not talking about some big market-wide margin call that.
Yeah, and I totally agree with you on that point. I actually think in the market-wide margin calls, then it's interesting because we've seen big 0 DT call positions come out. And I think oftentimes you could use those as, ways to sort of hedge maybe longer dated puts that you own. It's kind of an interesting thing, but, and that speaks to some of the balance maybe that 0D is offering. And then Bill Klein says that there's a problem with how margins technically calculated. I think the idea is that on the 0 DTEs, the margin's not fully calculated the way that it should be if you're kind of just flipping in and out of these contracts, and that's drawing some of their extra use cases, but we'll see what happens on that. RC says, wasn't volatility driven mostly by VIX ETPs blowing up? Yes, and it was the VIX short ETPs, because vol every time it would spike a little bit, everyone thought they were about to get rich, selling that and playing that mean reversion, and then eventually so many people got caught short that when the VIX actually jumped up, I think it was 50% was the trigger to have to break the VIX XIV. That led to this kind of unwind. And so I think to kind of Imran's point, it's like if the moves are within the expected range, those flows build up to keep shorting or selling against that expected range, or flows kind of try to reinforce a tighter and tighter expected range. And then suddenly you kind of like it pops, right? Because there's nowhere else for that range to go.
I think the thing that I noticed with the Volmageddon was that, it was that the AUMs were expanding, right? So XIV, I think the ETN went from something like 20 in early 2016 to 120 just before it popped, right? So it did a 6x.
Mm-hmm.
The AUMs in that ETN are exploding, right? So as those AUMs are getting bigger and bigger and bigger, the amount of futures that these guys actually have to short is getting bigger as well, right? So as vol's going down and the AUMs are increasing, they're having to sell more and more futures at a lower and lower level. So they're not adjusting for the fact that this is a mean reverting asset. So their AUMs are as big as they had ever been, and they were short as much VIX as they had ever been, because they have to replicate the negative return on the VIX. But that's when VIX is at 8, right? And that's the crazy thing, because from 8, it's a lot easier to double from 8 than it is from 15, right? And that was the thing that really screwed the XIV and those ETNs, right? It was just
yeah, and there was a lot of people that understood what needed to happen to break those ETFs. It was written in the prospectus, the move that had to take place, and could those people have just given the nudge that was required to kind of break this thing, knowing the asymmetric payoff that you could get?
I wouldn't like to speculate on that, Brent.
I wouldn't like to either, but the VIX really didn't seem like it was poised. If I remember correctly, it was like the last 5 or 10 minutes of the day where suddenly a big move was made, and who's to say what's wrong on that stuff? But that is just a fact. There's a lot of funds that had incredible returns betting on these implosion events. So. Really kind of quite interesting. All right, Imran, as we kind of approach the top of the hour here, anything else you want to kind of bring up as we head into this options expiration? Anything that you kind of want to note on the macro side of things in terms of rates, or you want to leave that till kind of post FOMC here?
Yeah, I mean, I just bought some VIX call spreads today. So like I already kind of said my bias right now. I think you want to be long a little bit of Vega in various forms. I think the VIX isn't a bad place, just because someone's come and carted so many upsides in the VIX that it gives you a bit of fuel to fuel a VIX spike. But whilst you're waiting for that to happen, managing a theta bleed makes sense, right? So iron condors for this Friday, I don't think are too bad as well.
Those are great insights. You want to pay for that carry, and I think really, if we do get an OPEX move, great. But then either way, out of FOMC and earnings, which is supposed to kind of materially pick up, then I think we'll have a pretty good directional bias kind of out of the first week of February, which probably sets us up for a bigger move into that March options expiration. So that should really, I think those events lining up should really start to give us a better directional move than we've had over really the last kind of dull 2 months. So before we shift away here, we always bring up the Hedge, which is our options trading course. In the top left, there's a QR code. Maybe it's on your top right. I always screw this part up. But if you take a snapshot of that, you can get taken to academy.spotgamma.com. where Imran and the SpotGamma team have put together an excellent training course. So you learn everything from what an option is all the way up to advanced portfolio management, hedging your deltas and things like that. So if any of the conversation that we touched on today was a little bit confusing for you, want more on that, please go check out that course at academy.spotgamma.com and join Imran there. As far as we go, we just launched our implied volatility dashboard. So if you want to try that out, go to spotgamma.com, try out the alpha subscription, try it free for 7 days. We're going to do a pretty big launch for that over the coming weeks. And Imran, what you got cooking?
Well, I got cooking. Well, I've got a new podcast dropping.
Oh, nice.
Called Crypto Options Unplugged. So for anyone who wants to know what's going on in crypto vol, that's going to be a weekly podcast talking about macro crypto and what's going on in vol space. First episode should be out sometime this week. I've got a new advanced options course dropping on my website as well, where I cover things like portfolio hedging and VIX products. Some of the stuff we've discussed today about VIX, I go into a deep dive on VIX and a few other things like crypto and some of our vol dashboards that we have on our side, and just sort of showcasing and explaining those in more detail.
That's excellent. So I was going to close it up after that, but you gave me an opportunity. We didn't talk about crypto at all. So give us the flyover here of what's going on in the crypto space. I feel like, you got a crypto expert here. Might as well ask him what's going on. ETF was approved. That's what led to this spike here, right? Up almost to 50,000, and then kind of a retracement there. So what's the lay of the land in the crypto space? What are you thinking here?
So it was the most well telegraphed thing ever, right? So everyone knew it was going to get approved. It'd been, everyone was long who wanted to be long for that approval. So the chances were there was going to be a bit of a sell the news type event. That was what most smart people were saying. We got exactly that. If you've made great money last year, you practically doubled your money on Bitcoin. So taking some chips off the table, banking some of that, given that the news was priced in, made sense. But that's not to say that this thing's falling out of bed necessarily, right? The macro is pretty supportive for it, given what's going on with rates, given that we seem to be getting the pivot and fiat currency debasement is going to happen again. The interesting thing on the approval was that Ethereum spiked pretty aggressively on even before we got the official news.
Yeah.
And so the next narrative is the Ethereum ETF. Ethereum's potentially got a lot of room to rally. It got kind of left behind last year versus Bitcoin. And so, it's now back in the limelight. Literally since last week, it's up 25% relative to Bitcoin from the intra-week lows. So Ethereum really kind of reminding us what it's capable of. And I wouldn't be overly surprised if Ethereum charges up to 3,500 or something like that in the not too distant future.
All right. You heard it here first. Imran saying big chase there for Ethereum. And, there was a couple bank research notes saying, hey, Bitcoin, 100,000, 200,000, all that sort of stuff. I don't really have an opinion on that sort of stuff, but it's hard to see, these inflows. And to your point, some of the other structural things going on in the world as, kind of pro Bitcoin. And just the fact that it's gotten kind of the blessing now from the SEC in a way, right? Which makes it a little more open to some of those bigger institutional funds. None of that stuff is new news here, but this Ethereum trade seems like to be the one that people are focused on now. Although it seems like it took a pretty nasty chunk down last week there. And that circles to the very last thing I want to touch on. I just want to pour one out for gold, which just cannot get its act together. Maybe one day we'll break this sort of triple top. I'd be happy from my bunker, my undisclosed location bunker, but it just lets me down so many times. It's like the Philadelphia Eagles, just keeps disappointing.
That podcast, someone's asking, where's the podcast going to be? It's going to be dropped on the Deribit YouTube channel because they are the Crypto Options Exchange, but I'll obviously be sharing links and stuff on my Twitter. So look out for that.
Awesome. I'm going to look forward to that, Imran. I will be listening intently. And then you and I have been doing the Monday morning calls. We have not done those for a while because as a European, you took off 6 weeks, I think, around the holidays. Very laissez-faire over there.
I wish.
So we'll be
if I recall correctly, you were in Costa Rica not so long ago.
I was in Costa Rica. Yeah, that's true. So that was one of the 6 days that was my fault. So at any rate, we'll be back doing that back on Monday morning. Been getting great feedback on that, and thank you all for that. All right, so we're gonna end there. Lou Pasnak, thank you for coming on. Ramin, good to see you. No, Ramin, I'm not an Eagles fan. I just want to take a cheap shot while I could. And gold is the beanie baby of hedges. Old news. That's right. All right. Thanks, Imran. I guess we're both looking for some S&P volatility that would be exciting, and then go Ethereum. All right.
Cool. Thanks a lot,
Take care.
guys.